Julian, usually you try and avoid being in the same country as me, let alone the same city, but actually for once we're in the same city in Dallas.
We're almost wearing the same clothes. I'm not in like a polar neck and you're in a thong.
Yeah, exactly. And it's 100 degrees here in Dallas.
Yes.
So. Look, it's good to finally get together, and it's a good way to do Macro Insiders.
Yes, perfect.
Because there's a shit ton going on.
Yes, interesting times. Very interesting times. Yeah. Things have, I think, I'm sure this is, for the subscribers, has been frustrating at times, and you always stress it, this way that macro, you can see the trends, nothing happens, the world ignores them. And then all of a sudden it has to start paying attention. And we're definitely, the process has started, right? A lot of the things that we've been flagging have started. The classic being, we were very skeptical about EM. Remember last year, talking about EM.
Yeah, and you were like, well, you need to lighten up. And then, EM rallied a bit further. People's like, well, what's this all about?
Right.
And then you actually put out a short trade recommendation last month.
Yes, this month.
And it felt like a stone.
Yeah.
And I just think there's a lot going on in EM that people don't see.
Right.
Because it's really deceptive when the S&P is going kind of, the S&P is okay. There's a lot of these leading stocks are still going to new highs. So people don't worry about stuff.
No. We've had some, we talked about some of the conversations we'd had with people when we were in Europe. And we had some really fascinating conversations as well in the Northeast. But one conversation really concerned me because we've both been dollar bulls. And some of that is built on, where we thought the US cycle would be, whether it's me and inflation. But a lot of it's this structural concern that you and I have had about how you basically have this shortfall of steady, sustainable dollars because the current account deficit in the US has been reduced via shale production, and we don't import as much oil. So that sort of number is dropped. And definitionally, something else has filled that gap, and it's been that capital account flow that we've seen as US investors have pumped a lot of money abroad. But we'd both be concerned about the fragility of that money, because it's definitionally hot money, and in a world where you can just go click.
And there's 15 trillion of it.
Correct. And you click and the money comes home. We've been concerned. Now, one of the things that I've encountered on trips where I've talked about this to institutional clients, I said, look, what if that money comes home? One of the pushbacks I always got from people was, well, look, if by definition, if the current account is too low and the capital account has to raise to offset that, if a flow within the capital account reverses, something else has to fill that gap. And is that the US banking sector having to lend its balance sheet abroad as financing costs and funding costs overseas increase in dollar terms? Well, a couple of conversations that we've had in recent trips have just convinced me that that is not going to happen in a smooth way. And so I think this, in the way that in a way that a lot of macro trends are trying to build on each other.
Yeah.
So weakness here triggers a crack here, triggers another crack here.
Right?
Yes. So I'm very afraid now that this emerging market weakness that we're starting to see, maybe we've hit a very short-term interim base here and the dollar looks a little extended around 115 in the euro. But the point is I find it very hard to see what's going to initiate a big risk rebound outside the US equity market. And in that environment, I'm sorry, I just think this is the beginning of a much bigger move. And I think, a modest correction in EM would take it down to 35. So your total move is about 20%. But that would be a very modest move. I mean, typically these things can go 30 to 40%. So I'm just not even, I know people always want to buy EM. This is not the time where I want to be doing it.
No, I think the same thing. I just look at the setup, and for me, it's an incredibly macro setup.
Yes.
And what we've got coming over the next 6 months, we had a very similar setup back in 2014-15, but the Fed were kind of not in the equation.
Yeah.
We've now got the Fed hostile as well. So we've got everything from trade tariffs to dollar liquidity problems, interest rates rising, demographics issues coming to the fore. There's so many things all setting up. China is slowing down. The EU has some big structural problems and political problems. So it's difficult to overcome all of those things right now.
Correct.
And usually it would be saved by liquidity. The only liquidity you and I have found is buybacks.
Right.
That's the only thing I can find that can stop this. And it could just keep the US outperforming, but I just don't see what's going to rescue emerging markets and
and
other
I
issues.
think this is one thing that we're quite keen to stress. I mean, you can have these periods of divergence, right? That's the key, word that people, the US is diverging from the rest of the world. Well, you and I have been long enough in the tooth to know that is never sustainable, because divergence definitionally means...
Every time people start writing about decoupling.
That's what they call it. Decoupling, yes. So you can get this decoupling, and what happens essentially is in a decoupling, and you can see the dynamics are all there to have a decoupling. US rates are significantly higher, so money continues to pour into the US bond market. US equities are outperforming, partly as you discussed because of the buybacks. The dollar's strong, so there is this natural sucking of cash back into the US. But it is highly toxic because we still live in this legacy dollar world. And it means, look, from an investor perspective, and for all you guys out there, yes, you're running stops closer, you're running risk tighter because things are getting more unstable. But yeah, where you're running that risk is in the US, and you're not touching any of this. But the trouble is more and more liquidity is pulled into the US, the more these other things crumble.
That's right, because you're creating a vacuum of liquidity
Correct.
there. And there's two forms of liquidities. There's the kind of monetary liquidity and the liquidity of markets, which is greatly diminished. So the problem is you're left with that diminished liquidity of markets to try and hold up when all the money's going.
Right.
And so this feels like it's a great setup.
Right.
And I'm itching to get short so many things. I mean, I was listening about in Global Macro Investor, I'm like, God, there's so many things. If I look at European car companies, I look at the Aussie dollar, I look at copper, I think, and we both probably agree, but we're scared of the fact that what happens over July could continue.
Right.
I imagine that July, because of where July 4th is in the middle, it takes that whole week. Generally, it should be a quieter month. We might get a bit of a bounce, but I'm worried about August, September, October. I think even the Trump narrative will increase because he's playing to a base that is not the capital holders, but the labour base of the United States. So he's going to say things that are very concerning to capital holders, which is trade war, which is, all sorts of different things. And as we step into that midterm elections, I think all of this is going to get really unsettling.
Look, I mean, both you and I have talked about the way in which equity markets tend to build slow rolling tops, right? You enter these periods of choppy sideways trading where volatility is starting to pick up.
Yeah.
That was one of the things that you highlighted last year to the Macro Insider client base, is you get that typical last minute pickup in vol. And what it does is it hollows out risk-taking ability. So when we look at a lot of those metrics, they all look very poor. We look at the institutional leveraged account base. It's very long, highly committed to the US equity market, but is seeing higher volatility. So its ability to capture any immediate drop-off in stocks, I think, is very limited. In fact, I think we could end up with a situation that if stocks were to start to sell off, these guys will actually be forced to sell into the down move.
Yeah.
I look at the institutional client base. We've looked at this smart money flow index for people. It's diverged massively.
Extraordinary.
In direct meetings with clients, we've had real pension money tell us that their underlying clients are de-risking. I mean, this is the story that some of the people may have seen in November of last year, where CalPERS came out, the California Retirement Fund, and came out and said, look, we've hit some of the watermarks. We are now actually de-risking, right? So we're taking some money out of the equity market and putting it into the fixed income market because we finally hit watermark levels after 8 years of trying to claw them back. We're a little bit more happy. So that, to me, if the market's just being held up then with buybacks and retail, is a strong to weak hand transference. So that's worrying. Most markets haven't done brilliantly well outside the NASDAQ this year. And we had $100 billion in the US market alone that went into January. So you've got a lot of trapped money in some of these markets. And these markets are already starting, to your point, whether you look at European markets or emerging markets, are already starting to underperform. But it takes quite a time to build that bigger top. And so when you look at September, October, and you ask yourself, what could happen, right? And this was the whole piece that we wrote about financial conditions this month. And we said, if you look at financial conditions, and there's sort of 5 basic metrics that go into any financial conditions model: short-term rates, in other words, the Fed, bond yields, the equity market itself, some element of credit, or the dollar. The one that we're quite focused on at the moment is this dollar, because we're just very worried about these structural dynamics, and we get this final big repatriation of cash, whether it's partly because of the tax thing, whether it's a risk-off move overseas, whether it's this, decoupling and money's just sucked back to the United States, that effect is going to be profound. And for the client base, this is what you've got to be insulating your portfolio against. You do not want to be caught at this point with essentially a short dollar exposure. And I think we'd both agree on that.
And almost everything is a short dollar exposure.
Correct.
Almost all risk assets right now. And I don't think people understand those macro linkages.
No.
And I think that's super important. I mean, the one that I've been trying twice now is the short side of oil.
Right.
Because for me, there's 2 things left in this global equation. Almost everything else is crumbling.
Yep.
We've got the US equity market and the oil market.
Right.
And those 2 things are the last providers of liquidity and returns
Correct.
in the market. Both have got massive all-time record speculative positioning. And my fear is that obviously the oil is priced in dollars.
Yep.
So if the dollar is strengthening, oil should start weakening. So it's opening those alligator jaws. Trump is already trying to talk down the dollar. There are some structural supply problems, not the dollar, sorry, oil.
Yep.
There are some supply problems that will get alleviated.
Yep.
And if you're not careful, that's what's holding up the ISM to me, because such a large part of America is the oil patch. If that goes, then I think everything goes. And the equity market is part of that whole final part of the risk taking. And you and I were talking off camera about the rolling top in 2000 and how similar this is, where first is the bond market yields peak, then it usually ends up being emerging markets, then maybe the equity market, or
elements within the equity market.
That's
right. I mean, I think
that's right, because the leaders always keep going till the end.
Right. Or and I look at it. We just put out a piece to the institutional client base today, looking at some of the comparisons to some of these, and I know you've done it in the past. Some of these big leading high beta single stocks and the comparisons to, say, similar stocks in 2000, right?
Yeah.
Cisco and Netflix. I mean, the chart is, uncannily similar, right? And I think, there's a lot of momentum in this US economy. We gave a very simple metric in one of the Q&A sessions on the website, which I'd encourage you guys to use, because we do answer the questions, where we looked at the 50 and 20-week moving averages. And it takes a while for those things to cross on the S&P. But don't forget that the S&P is one thing. Netflix and the NASDAQ is quite another beast, right, given the relative outperformance. So we could be entering a period where, as this liquidity is withdrawn from the Fed, that we're seeing, as Raoul said, the most sensitive sectors start already to blow up, emerging markets. Now the dollar's starting to move. It would be interesting, I think, to start to see if some of these really high beta stocks in the US start to lose momentum, because in a parabolic up move, and this is one, it goes back to a year ago when we were shooting the first production videos for Macro Insiders, we talked about the anatomy of a bubble. And there's a lot of US stocks out there that have very, very similar patterns to that. And it's essential to maintain that momentum. And it's being fed by liquidity, guys. So as this Fed continues to withdraw liquidity, and increasingly this month, this quarter we were drawing 40 billion a month, and then next quarter we go to 50 starting in September. That's a lot of cash to come out of the system, and those very high sensitive, liquidity sensitive things should start to wobble.
And there's other things around that could change the sentiment. I think everybody fears Tesla right now.
Right.
Now, if Tesla goes the way that I think it might do, which is Enron, but I don't know, but look, it's playing out in a similar way. What does that do to these other companies? People are just going to go, okay, I'm out of risk, because I don't really understand what these companies are about anymore. There's no cash cushion to help me. And Netflix, classic example, a company that burns, it's a great business, but burns too much cash.
Right.
So if less cash is available to fund that kind
or it's more expensive.
Yeah, then the chances are that these stocks could fall 50%,
right.
another 50% again, and still be great companies.
Correct.
Like Cisco.
Yes. We haven't pulled, both of us are reticent to do it. We haven't signaled the sell US equities, and we're not at that point yet. But like just as we did at the end of last year, saying, look, if you want to be in EM, stay in EM, wouldn't be our call, okay, but run a closer stop. Okay, and this is
there's no stops left in EM.
No, but I mean, but that's gone now, right? And now we're pressing the shorts. Okay, we started in April and May to suggest shorts, and then we pressed them again this month. But the point is we're not there yet in the US equity market, but this is where you should be running tighter risk. Okay, because things move very rapidly. We've been trying to stress that to you guys. When you're managing your own money, you know, it is not a passive investment environment. This is the absolute antithesis of a passive investment environment at this point.
I'm kind of maybe contentiously going to suggest that both of us are going to end up shorting developed market equities by the end of the summer. It feels like it's coming, right?
It feels like it's coming, mate.
It feels like it's coming. It feels like these things are going to break down.
As I said, it was just this week that we highlighted to some of the institutional clients that we're getting concerned by these high beta, momentum-driven, liquidity-driven stocks. I mean, I think we put out earlier in the year, we put out what happened in 2000 and how the Fed had increased all this liquidity, you remember, ahead of Y2K. And I remember seeing a client in London who was the London office of a big New York hedge fund. And the NASDAQ was up 100% year to date. The Fed increases liquidity. And I'd looked at this on a chart, but I'd never had confirmation. And this guy said to me, oh yeah, the boss of the hedge fund came over the hoot from New York and said, they've given us liquidity, start buying shit. And literally the NASDAQ took off, and then they withdrew the liquidity, and that was the high. And if you look at this cycle at the moment, you've still got liquidity pouring into these US markets, you know, from this outperformance, external capital coming in, but the Fed is starting to withdraw that liquidity. And we've been very, very clear, both you and I, that this is nothing to do with fundamentals, right? You listen to CNBC and these guys will be saying you, oh, it's PEs and the earnings are great and whatever. But the fact of the matter is these prices have been inflated by monetary debasement, right? Printing money, right? Literally, this is as old as the hills. This is clipping the corner off a bloody gold coin, right? I mean, essentially, this is Weimar Republic-esque economics wrapped up in some veneer of central bank credibility. But the reality is when that liquidity starts to get withdrawn, assets have to correct. And we're seeing it in some now. And the risk is it starts to move to the core of the system.
The other thing that I wrote about in the last Macro Insiders, which came from GMI, and something I've been talking about a lot, and I've talked about on Twitter a lot, is also I have never cared about geopolitics. You came from a slightly geopolitical shock from before, from Medley, and I've never cared because geopolitics didn't really matter. It was more macro that mattered. And now suddenly geopolitics is coming into the form. We're all having to scramble to catch up. You know, I've only just really understood what the rules-based global order system was, the setting up after World War II of everything from the IMF to the United Nations to the World Bank to, you know, and then it extended to the WTO, and probably the greatest example of all, along with the WTO, was the EU.
Right.
All of these massive, NATO, all of these things are rules-based global order. And what you're seeing is the US walking away from much of that, or at least changing the format of it into a place that is not understandable.
Right.
So that's led a splintering in the global balance of power. So the Russians have grabbed a lot more power. The Saudis have grabbed a lot more power than they've ever had. And then they're forcing a situation with Iran. Iran has a reasonable amount of power. China obviously has power. India has power. And Turkey has power. And we don't know how this is playing out. But China's already setting up a separate set of rules-based global orders based around China only, not global. They're saying we don't need to be global. The US is walking away. Trump has specifically gone out. He's attacking OPEC. He's attacking WTO. There was that report in Axios that they're going to walk away from this. They've already walked away from G7, essentially. First time that's ever happened. And how do you price risk in that environment? Nobody has a clue, because you don't have that kind of global peace dividend. We're not saying it's going to war, but you just have the shifting dynamics of who does what to whom.
Right. I mean, to me, it's a, and I've written this to the institutional client base. I said we're in a pseudo Cold War environment, right? People,
but it's not between two powers now.
No, it's multiple. And I do think that the equity bulls, just don't understand about the extent to which, and we were talking about this off camera when it came to CEO pay discrepancies, that the capitalist sector and the equity market has been great at exploiting this globalization that has occurred since the collapse of the Berlin Wall.
Yeah.
Right? And if we're going back to a more truncated supply chain where, whether we like it or not, we have to start producing things at home because the risks, whether it's the actual physical risks of being able to get the supply or the institutional risks of you being seen to getting all your components from China, right, suddenly start to rise, that is truly, truly caustic to these trends that have been driving and CEO returns or shareholder
and think
returns
this through.
And PEs.
So we can see how difficult it is for Brexit to occur, right? The legal structural framework, let alone the trade negotiations.
Right.
Britain's not even started that.
Right.
And the weakness is they need to get a trade deal as fast as possible. So you are any country negotiating with England, what are you going to do? Drag it on for as long as possible. Yeah. 10 years, even better, because it makes the UK weaker. Now, if the US is going to pull out of WTO, they're going to have to negotiate each individual trade deal.
Right.
So where does that leave any business not knowing what tariffs it is when you're selling into Brazil versus Japan versus the UK versus the EU, and nobody knows?
Right.
What is that going to mean you do? It means you have to take less risk as a corporation. And the risk is that you're going to get caught out in one of these unintended consequences of a trade deal with Japan that bedevils somebody else, because in a trade war where it's not driven by one person, i.e. the rules-based global order run by the US, it's in everybody's interest. You have no idea where it's going to lead to.
No, and it leads to cultural and intellectual imperialism and nationalism. Is probably a better term, actually, when you think about it. I mean, it's not inconceivable to me that in a year from now, if this thing has all got increasingly sort of ugly and Trump's won the midterms, that he turns around to Apple and just says, no, you can't build the new iPhone 9 in China because there's some component in there which is considered militarily significant, so you have to build it back here. These corporations who've had it so much their own way and essentially have hollowed out their domestic economies by exporting jobs and exporting capital to the cheapest production, enriching themselves and particularly the management in the process. That process has to reverse. And we wrote about it this month for Italy, right? I mean, Italy is that culmination of this globalization writ large, this sort of multinationalism, this overriding sort of dominant blocks led by small global elites. And that is truly breaking down. And the stress that it can bring to the system. I mean, people, would say to me, I'd meet socially, would like, what the hell happened last week when Italy blew up? And they're like, why do we care? And they don't understand that Italy is the world's third largest bond market, right? Third largest. And if Italy causes enough stress in the system, it can bring the whole global system down.
Yeah.
Right? So there's lots of things.
But you see, what's happening
now.
is, and what's interesting there, this is not an isolated event of the market pricing risk. It's the general movement of politics to walk out of these.
Within that broad economic cycle, right? It's these extremes of the cycle which periodically tend to culminate with extremes of politics, right? It's the economics that drives.
Yeah, but maybe this is a secular shift in politics, is my
my
view, and therefore, if regardless of whether it's the Spanish, the Catalans, the Scots, whoever it is, this and Brexit was the first big part of this.
Correct.
Is that dismantling of the EU structure as we understand it today is going to happen. Whether Italy does it this time, we've just seen Merkel get into a bit of problem. It's a matter of time before the Germans reject the system that they have constructed around themselves. Right. So they're just steps, and when it comes, it comes. And all of this, I think it just leads to a more volatile world than we're used to.
Correct. We've lived in this sort of halcyon environment which corporations have been able to and allowed to, whether it's right or wrong, to manipulate to their benefit and to the benefit of their shareholders. And now the worm has turned. I mean, if you look at, this is one of the points that I remember in a podcast that I did saying, look, if you look at the politics that are being led by the right wing, not by the left wing, right? We're seeing in Latin America the left wing come to power, but look at developed economies and what the right wing is saying. So in the right wing in the UK, Theresa May came out last summer and said, if you think you're one of the global elite and you live in London and you don't have anything to do with the UK economy, think again, okay? It was a very firm speech. You've had Donald Trump come to power. He's the right wing, okay? The epitome of the right wing. And who's he appealing to? The American worker. Okay, and in Japan, we've had Abe proposing tax policies where if you're a Japanese company and you give a 3% pay rise, we will give you a tax cut. If you don't, we will actually tax you even more. So this is the right wing, right? What happens if the left wing start to come to power? What happens if you get a Bernie Sanders come in? Right, or Corbyn in the UK.
But I think this is inevitable. As we're getting more and more polarised, and economics driven by social media and how the world is depolarising or polarising because of the way people interact now. It's more tribal-based system. Is the more you do that, the chances are now. There's a number of outcomes that could happen with Trump, whether he goes to prison or doesn't, or whether he wins the midterms and gets softened. If he doesn't win the midterms, then I think the chances are that the wrong side of the left, it keeps going until it blows. And I don't know whether it's going to be blown up by the left or the right, but somebody's going to blow it up. And it's happening in Europe in the same way.
Correct.
It's only when you blow the whole thing up can you rebuild it. Because right now, all we're doing is this every time. Just keep moving wider and wider and further apart, which just makes people angry. And it makes that politics become populism by definition.
Right. And for the markets, it creates, to your point earlier, it just creates inordinate uncertainty. So when you do that, when you've got the politics beginning to get increasingly unstable in an environment where the macro cycles are becoming desynchronized to some extent, and the volatility around that benign environment where the money's just been printed, right? And now the money's starting to get taken away. This is not an environment, guys, where you want to be running, an excessive amount of risk. And I think that the one thing, as I said, that I think both of us have been emphasising is, managing risk, which probably brings us to one of the questions that we got, which I think is probably more apropos for you since you have run money in your past, is how do you think about risk reward and how do you manage risk?
It's one of the hardest questions in the world, right? Yeah. I remember when we had, on Real Vision, we had Carl Bass and John Burbank in a series called The Chain. Carl's first question was, how do you size a position?
Right.
Because nobody knows. How I think about it is, at the basic level, I construct it based on the size of the stop loss that you're prepared to lose money. So let's say you could have 100 bets of betting 1% before you lose everything if they all go against you. So you think about those. So in a normal stock position, you try not to risk too much. You don't want to lose more than 1% on your overall portfolio. And that would be a position with a 10% stop, that kind of size of thing. Okay, that's all right. But then when you come to currencies and bonds, you can take much more risk.
Right.
And really I use charts for that and then trying to understand, okay, what is the risk reward of this?
Right, so you're looking at a target and then you're setting a stop, or you start with the stop and then look at the target? How do you...
It's a combination of the two, right? It's not worth doing, I've always thought, unless you can make a 3 for 1.
Okay.
So if you're going to risk 1% of your overall portfolio, you should be able to make 3% of your portfolio. Right. Now, there's sometimes, Bitcoin is one of them, where you get a wildly skewed risk reward.
Right.
And when that comes, you don't need to take a lot of risk because you make a lot of returns, but those things tend to be very, very volatile. The less volatile things, you end up with tighter stops. So volatility is a function of how tight you can have your stop. You have a tighter stop and you can run a much larger leverage position, which is why really the macro guys make more money out of everything out of bonds.
Right.
Or the short end, even better. Eurodollars, people have probably made more money out of trading Eurodollar futures than any single other thing in the world because it's not that volatile and you can use massive leverage. And if you think about it in terms of interest rates, if you think that interest rates are going to go from, let's say where they're priced in now, let's say
2.85.
Well, if we
2 years?
Short end, 2 years.
Yeah.
Where's the 2 years now?
2.5.
2.5. Right. So if they go from 2.5 to 0 again, how much further can they go up?
Right.
Maybe another 100 basis points.
Right.
So you've got 100 basis points to make 2.5. It's not a great bet, But once you get closer to the stop loss, which is that 1% down, then you can take a much more aggressive risk or use options.
Right.
Which is why I've used options for the euro-dollar trades we've looked at in Macro Insiders. So the problem is with trade sizing is you need to look at the overall portfolio, the correlations between everything, but assume that everything's correlated to one, because when it goes wrong, everything goes wrong in your portfolio. And then look at the volatility of these asset classes. You can even adjust volatility, divide the particular instrument by volatility, and just look at, can I make 3 times this? If not, it's just not worth it. Right. So a complicated world. The other one people asked us was about, okay, Italy.
Right.
It's under stress. How do I trade it?
And that one's a tough one. I mean, it's actually quite hard for, you've read the stories about some of the big hedge funds making money in the last month or so out of Italy.
Yeah.
Household names that we've seen the stories on. And clearly they have a plethora of all the products to kind of trade, although there isn't a currency, which is kind of a pain in the arse. Although actually one of the things that turbocharged the short euro recommendation we gave you guys on the break of 120, 175 was obviously the Italian story. The one chart that is, I think, a good metric for stress, but I wouldn't suggest that anyone in the retail space particularly trades this unless you've got an account with, say, Euro brokers and you're trading futures, are 3-year BTPs. They're actually, that spread between 3s and 10s is really, I prefer it to say bunds versus BTPs because you're keeping the story truly Italian. But when you get the bear flattener, so the short-term yields rise more than long-term yields, you're really pricing in some sort of default metric there. So that's one I would watch, 3s, 10s, and as we get towards September, October, when they have to come up with a budget. One of the things I discovered in Europe was that they have to they're talking about coming up with an interim budget on the 15th of October. So I think that's when tensions could increase again. The euro is an obvious way to play Italy. That's, I think, a clean, easy one. It fits also with our view about the dollar in general.
That's right. You get the double kicker from it.
Yeah,
I think.
Exactly. So I think that's down. That idea is sort of going down to sort of 105 is our structural view. 115, we're kind of at some biggish kind of levels. We've had the short on for 5-6 big figures. It's worked well. A little bit of choppiness here, but we are still basically sellers of rallies of the euro and buyers of dollars. Another way I think you could look at it, obviously, is in the Italian equity market or in the broad European equity market. But you do need to be a little careful there that if we ever got to the point that we were truly looking at Italy leaving, you'd actually want to be buying Italian equities, right? Because if they did redenominate...
Yeah, but at what price do they have to be before they...
I mean, they fall a lot...
And then
and then they rally very, very hard. And as they leave and they reinstitute the lira. So I think you can look at, my preference would be FX via the euro. I think that's a good way of playing that tension. It fits, as I said, with the dollar view. And then secondly, I think the equity markets in Europe.
Yeah, I think any of the European banks.
Yep.
You can buy puts on those, so you can sleep at night.
Yeah, the French banks in particular.
French banks. I think that's a relatively straightforward bet. And we all know the underlying problems at Deutsche Bank.
Yeah.
So there's a macro backdrop outside of just Italy.
Yeah.
Also the dollar funding crisis. All of these big banks fund themselves in dollars.
Correct.
So they're at the epicenter of that. So I agree. I think the euro's the cleanest, easiest way to play this. And again, you can just buy options on it.
Yep.
So you can buy puts on the euro. So let's say we're all wrong, everything is fine, and the euro goes back up to 120, fine. You're not going to lose much money, but if you get it right, you'll make a shit ton, which is the risk-reward basis of what we were talking about. Is,
And it fits with the broad view that I think, to the extent that we're still pro-risk, it would be pro-risk in the United States. Right? It's the US equity market. So, for those of you who have got overseas...
But you aren't really pro-risk.
No, I mean, but it's the extent to which, if we're...
What you're saying is I understand if you still want to remain long, but but you might be an idiot.
No, I mean, it's look, both of us think you're eking out that final risk move, if it happens at all, right? We both think you're essentially at this point picking up pennies ahead of a steamroller, okay? And because there's too many clouds out there and things that could go wrong that could undermine the whole thing. But if there's any place that, if you still have US equities, that's fine, okay? But just tighten those stops. And outside that, I think we're out of all equities, right? We don't want to be in Europe.
No.
Okay, it's starting to horribly underperform. Horribly
I've got
underperform.
one stock left in India,
Right.
which is still doing fine. That was a long-term thing, but
Right.
people made a lot of money in that name, and if you don't want to take risk,
that was an incredible trade, right?
And if people don't want to take the risk any longer, take the profits,
Right.
and you can always get in later if it falls. I have no idea.
Right.
If the oil price falls, whatever, the Indian tourist market, could that pick up again? Possibly, probably. But yeah, I think no equities.
No, I mean certainly not outside the US. I wouldn't have a single thing. And in fact, as I said, we were short. We've gone short Europe, EM.
And I think my best trade to come is a broadening out of a lot of dollar long positions.
Yes.
I just want to see how this July moves, get some ideas to see whether the market patterns are the kind of patterns I'm looking for. I'm looking for, some head and shoulder top formations, other bits and pieces. If we can get some sort of benign correction in some of these long dollar trades, then I really want to be involved in a whole number of them.
Right, and I think, a lot of people have asked us questions about how we square the bond difference. Look, here's what I would say. This is a late cycle inflation surge. My view is that this is going to really complicate the hand of the Fed. Okay, it's really, really going to complicate the hand of the Fed. Now, it's possible that 10-year yields don't rise that much more. We've got enough turbulence that there's flows coming in from all over the place.
The Fed are going to raise rates.
Right, and we recommended cutting those bond shorts, the TLT positions. But the point is because you've got these culminating factors coming together, if we start to see an accelerative dollar move, what the hell is the Fed going to do? Right? If they've got inflation prints coming through on the one side and an accelerative dollar move, it's just going to make, the point is, it's just going to make overseas that much more
But this
painful.
is why, yes, but this is also why I quite liked the long bond trade over a longer period.
Right.
If I think of 18 months, because the Fed are raising into a global issue.
Right.
The probability of setting off something larger is getting higher and higher
Right.
every time they raise. The bond market, particularly 10 years and out, has to start looking, okay, what is the probability of future inflation versus future deflation? It's going to have to price in some problems. So the long end tends to rally like hell. And that, that's why I just think the risk reward in that one now is good enough to do the trade. And if you do it via options, your TLT options, it's super easy because then you don't have to worry because volatility is so low.
Yeah, I mean, I wouldn't pull the trigger just yet. I've got to be honest with you. I'm still watching sort of like 280 on the downside in 10 years and then sort of 310. But the big level we're watching is 320 on the 30 years, that 100-month moving average. But look, and my preference would be if you think there's a big trouble, sell some fucking stocks, to be brutally honest. Right?
Yeah, well, I wouldn't. Shorting them is terrifying still, right?
Right.
Because to short.
Well, we've done EEM, right? We haven't done the S&P yet or the NASDAQ.
No, that's right.
We've done EEM.
That's
and
right.
I feel much more comfortable with that as a view.
Agreed. But it's coming, right?
But it's
so
coming.
I just think, just to kind of wrap up, is I'm starting to get, and I think you get exactly the same sense, that the next 3 or 4 months is potentially going to be an incredible macro environment.
Right.
And I'm just getting very excited over it. I'm kind of itching to pull triggers all over the place, whether it's in equity markets, whether it's in the dollar, all sorts of opportunities are coming, whether it's in commodity markets. I think it's coming.
And I think, look, you and I have been at pains to stress this. We've had this product for a year. It's been a lot of the time was actually trying to educate people about what we think about, what we look at.
And all the broad range of things you need to look at having your dashboard.
Correct. And I think, you and I, rather than the viewers, have been frustrated at times that this is the nature of macro, particularly in a world where central banks have been so manipulative in terms of their policies. But we all think that we're just coming now into the window where macro starts
it ticks every box for me.
Correct.
And even geopolitics, which has never really been a feature of my thing. It's like, okay, this is macro geopolitics now.
And so I think, hopefully we're coming to the end of this period, and I think next year, as we look next year, there are so many things, even in the next 3 months, that could get. This is when you're going to earn all your money, or hopefully save, viewers money, because people forget this. I mean, everyone, you go and talk to these wealth managers, and we just want you to stay, in the box. No, what you want to do is truncate that bloody downside tail. And this is an environment where you do it. Your management of risk, create some opportunities. I think we're going to get a lot of opportunities. Yeah. I like, right at this point, I like silver again. We've come right back to that very long-term trend line at around, under $16. Gold still seems a little expensive to silver on a ratio, but I like these things are starting to come together. PA, I think I'd be tempted to just have a little bit of silver here just to watch it. Could go a little bit lower, but it's actually traded really well comparative to gold because it hasn't had the ownership.
Yeah, gold I think still needs to come down a bit.
Yes, because it hasn't had the ownership.
I think we both strongly think that gold plays a big part of the next 5 years.
Correct.
It's now about timing and finesse. Right. And I don't get the risk reward now to enter it, because the further I can buy it down to kind of the 1100 level or so, the increase in the risk reward goes up massively.
Yeah, it's like, look, I don't fundamentally disagree with that comment that we giggled about at the end of last year, emerging markets, the trade of the decade, right? We just said from what level? And I'm not buying them where they were there, right? If we get them 20 or 30% lower, I think they would be the trade of the decade.
Yeah, because at some point the dollar weakens. Then the dollar generally weakens for a long-term cycle, and emerging markets explode.
Correct.
Now, it's not going to be the same emerging market cycle that we've had in the past because of this splintering of geopolitics, but that makes it more interesting because you get longs and shorts. It's not just a correlation of one.
Correct.
Which is you just buy anything and it goes up. Yeah. You'll be able to choose between, long India, short China, or whatever it may be.
Yeah.
And that'll be interesting for us.
It will.
Anyway, let's see what happens. Hopefully we get a bit of time at the beach.
Yeah, right. You're more likely to get to the beach than me, mate.
Yeah, before the shit hits the fan, but I feel like the shit is about to hit the fan.
Yeah, agreed. Nice to see you.